This is TradeFlow News, bringing you relevant news and insights from around the world. TradeFlow News, enabling trade for SMEs and economies worldwide.
These are some of the key topics that we will be looking into in today's program.
First, let's take a look at the overnight headlines which are impacting the commodity markets.
Venezuela's state-run oil company PDVSA plans to increase digital currency usage in its crude and fuel exports as the U.S. reimposes oil sanctions on the country. 3 people familiar with the plan said. The U.S. Treasury Department last week gave PDVSA's customers and providers until May 31st to wind down transactions under a general license it did not renew due to a lack of electoral reforms. The move will make it more difficult for the country to increase oil output and exports as companies will have to wait for individual U.S. authorizations to do business with Venezuela. PDVSA since last year had been slowly moving oil sales to USDT, a digital currency also known as Tether whose value is pegged to the US dollar and designed to maintain a stable value.
European diesel futures spreads are flashing signs of oversupply and slow demand with the 3-month contango trading on Monday at its widest since August 2021. Contango is a market structure in which a current contract trades at a discount to a contract for a later date and usually gives traders a signal to store the fuel to maximize profit. On Monday, the May low-sulfur gas oil futures contract traded at $6.25 a metric ton below the August contract and more than $3.50 below the June contract. The May contract flipped from backwardation into contango late last week.
Moving on to the top news in the energy sector.
The Biden administration is expected to drop green hydrogen from its landmark plan to slash greenhouse gas emissions from the power sector, to reduce the risk of lawsuits if the nascent technology doesn't reach commercial scale, according to 3 sources familiar with the matter. The move reflects skepticism within the U.S. government that the technology, in which hydrogen fuel is extracted from water using zero-emissions energy sources like wind and solar, will develop quickly enough to become a significant tool to decarbonize the electricity industry. The Environmental Protection Agency will unveil its final rule as soon as Thursday, the sources said, marking a huge milestone in President Joe Biden's strategy to fight climate change.
As U.S. shale oil boomed last decade, an oil pipeline company pitched an ambitious multi-billion-dollar export port off the Texas coast to ship domestic crude to buyers in Europe and Asia. In April, Enterprise Products Partners SPOT became the first project to receive a license from the U.S. Maritime Regulator for a deep-water port that could load 2 supertankers, each of which can carry up to 2 million barrels of oil at a time. But multi-year regulatory delays, a loss of commercial backers and slowing U.S. shale production has left SPOT, or Seaport Oil Terminal, and its 3 rival projects without any secured customers, energy industry executives say. Next, we have the top news in metal markets. Flourishing activity in the electric vehicle, power infrastructure, AI and automation sectors will lead to at least 10 million metric tons of additional copper consumption over the next decade, commodity trader Trafigura told Reuters. Technological developments such as artificial intelligence and automation, and the energy transition, which includes electric vehicles and renewable energy, have already driven up demand prospects for copper cable used to conduct electricity. Estimates of new demand from these applications vary, but Graham Train, head of metals analysis at Swiss-based Trafigura, said 1/3 of the 10 million tons of new demand would come from the electric vehicle sector.
China's coal consumption will fall by just 1/3 by 2040, according to a report by a European consultancy published on Tuesday, threatening climate targets that call for phasing out much of global coal use by 2040. The International Energy Agency has said that global coal power capacity has to be eliminated by 2040 to keep average global temperature rises within the key threshold of 1.5 degrees Celsius. However, Norwegian risk assessment firm DNV said in its report that its findings indicate China's coal consumption, the world's biggest, will see a minor uptick in the next 2 years and then fall by 1/3 by 2040, ending up at around 25% of its peak in 2050.
We will now look at the top news in the agricultural sector.
Brazilian farmers in Mato Grosso state have cut the area planted with second corn this season by 10% as low prices push them to cultivate alternative crops, a trend they say is likely to continue. Brazil's second corn must be sowed immediately after the soybean harvest to avoid the dry and colder season. In 2024, it will represent about 77% of national production, according to crop agency CONAB. I am discouraged about planting corn in the coming years and in the next will try other options, said farmer Jose Soares, adding he is experimenting with canola this season and others were cultivating sesame, mung beans, chickpeas and castor.
That is all for today's news on commodity markets. Stay tuned to Trade Flow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at TradeFlow News, which allows you to watch our program on your mobile device or desktop to receive information from there.